And we want to bring in some folks for some outside perspective now. Nathan Sheets is with us. He's Citi Global Chief Economist, as well as Seema Shah, Principal Global Investors Chief Strategist. Thank you both for being here. Nathan, I want to start with you and just kind of get your first blush reaction to this report, and in particular, that average hourly earnings number that didn't show any change month over month.
Well, I think that this confirms yet again that we have a red-hot labor market. There is an extraordinary bid for labor out there, and that the big question is, where is the supply going to come from? And, that reserve of folks who are not in the labor force as a result, or not working as a result of the pandemic, that is rapidly diminishing, and the labor market's tightening. Now, how do I reconcile the softness in the average hourly earnings number? Kind of my instinct there is that there's likely a pretty big compositional effect, that there were some folks who didn't work during January because of Omicron. They came back into the numbers in February, and it pulled it down a little bit. I'd very much want to see where things land in March.
Seema, Nathan notes correctly, I would say, we have a red-hot labor market in this country. Is that good or bad for stocks?
So I think it's good to some extent. The market has already priced in Fed hiking. We know that's coming, whatever comes through in the next couple of weeks. So, this is, I think, just affirmation that the economy is strong, and hopefully it's going to be strong enough to digest the rate hikes that are coming, as well as some of the potential downside effects to growth.
And what about the pickle of the Fed, Nathan? That's to put another way, a lot of our guests have been saying to us, the Fed's ability to engineer a so-called soft landing, it's going to be tough. Do you think that they are going to be able to do it, given that red-hot employment market and given what we're seeing on the inflation side, wages aside, I suppose?
The Fed's got a first-order challenge in front of it. Speaking bluntly here, we've got a hot labor market, as we've described. We've got 7.5% headline inflation. We've got a solid economy, and they're still at zero. And getting policy back even to something that we might call remotely neutral is still a goodly distance away. Now, given the near-term uncertainties, and even apart from those near-term uncertainties, the center of the Fed's leadership has been signaling that they prefer to move very incrementally and to see how the economy and the markets respond. But make no mistake, they have 7 meetings this year, and the possibility of 725s, which would add up to a substantial step toward neutrality, is very much on the table. In addition, Jay Powell has left open the possibility that maybe a little bit on down the road, there could be some 50-point moves. So Fed clearly behind the curve, but they're swinging into action. And I think that what we see over the course of this year is likely to be significant.
Seema, what do you think the market is likely to take its cue off of over the next few weeks? Is it a better than expected jobs report like this, or what is happening with Ukraine and Russia?
I think it needs to take both of them into consideration. I think in the immediate future, it's about the economic data. Where is it today? What is the urgency for the Fed to move? And clearly from today's number, as well as probably from the CPI number coming next week, it's going to be very clear that the Fed has to move. And as Nathan just said, they are very, very behind the curve. They need to get going. Now, fast forward kind of 3 or 4 months, then the market needs to start looking at financial conditions. What has happened to them? Are they already tightening? And then maybe financial conditions are already doing some of the job for the Fed, taking a little bit of heat out of the economy. So those are the things that we need to be watching. But I think as of today, and whatever happens in the next couple of weeks, I think Powell has made it very, very clear inflation is the top priority, and that is what they have to respond to, and they need to respond immediately.
And given that, it seems to me that the jobs report today, Seema, doesn't change anything from a strategic point of view for you in terms of what you're doing with asset allocation, et cetera, or am I wrong?
No, you're absolutely right. It doesn't change anything. I think this is in line with what people are expecting. We were expecting to have a strong report. Maybe many weren't expecting it to be this strong, but it's still in a similar ballpark. So we continue to think that the US economy is a place to be focused on right now. If we talk about the Fed's dilemma, well, the ECB's dilemma is considerably worse. They're potentially looking at a more significant economic slowdown, as well as very elevated inflation pressures. So no, from our perspective, it's still US over Europe, but still risk on. This is fundamentally a strong economy. So through all of the things that we may or may not see over the coming months, we would still expect the US fundamentals should drive market returns.
Nathan, I want to just think about this in layman's terms. Do you just find it crazy that we have a Federal Reserve here that is going to let inflation continue to run close to double digits? More companies have come out in recent weeks, warn that inflation is far from transitory. It remains very high. People are going to go out this weekend, spend close to $5, if not more, dollars a gallon to fill up their cars. Doesn't the Fed have to step in here with something more aggressive? Can't they not? They can't afford to move gradually, like you mentioned.
This is, make no mistake, the most significant inflation challenge that the United States has seen in decades. And as you suggest, the underlying drivers of that inflation are profound and deep. They are the strength of US demand and especially the US consumer, but also a whole host of underlying global issues. If you look at global producer price indexes around the world, they're posting double-digit gains. And it is incumbent on the Fed to respond. Now, that's happening against a backdrop of a generation of central bankers that have learned that gradualism is the right approach. And they have strong preferences for 25 basis point moves. And I think we're going to see in this instance, as you suggest, whether that's sufficient and whether over the course of this year, they get traction on inflation. If they don't, then I think that the Fed's DNA is that it's empirical, they'll move more. But I think up front, they have strongly signaled that at least for now, it's 25. Could that change as quickly as the May meeting? Absolutely. And that's something that's very much on our radar screen. It could be 50 as early as May. But in any event, they may need to do more than those 25s that I described before.
Yeah, a lot of the market participants are probably pushing in that direction.